Hello, this is Mitch Goldberg. You're watching Be the Boss of Your Money. And I just feel like the background is a little plain because I didn't turn on my background lights. Hold on. All right, that's better. Get the scene set up. You're watching me in action. Look, this is a live show. You're watching me in action. And believe it or not, I don't just do live streaming. I actually have a real job. I love doing the live stream. It is how I keep in touch with people. It's how I grow my business. It's how I make the world a better place and give something back to the world for my success and gratitude. So here we are. I share with you the knowledge, helpful information, market updates, but most importantly, perspective about the market and personal finance so that you could make the best possible decisions, financial decisions for yourself and your family, and maximize your potential to retire in the style that you would like. Okay. There's only so much you can do if you haven't been a good saver and investor for years and years and years. It's really hard to play catch up. You know what the problem is when you play catch up with saving and investing? You wind up doing aggressive things. That's the problem. You do aggressive things. You take a lot of stock market risk. You start buying things that you have no business buying. Speculative, very speculative stuff because you're looking now for the Sunday punch. You're looking for something to kind of like, shoot your personal finance years ahead with that much effort and with that much time. So you buy speculative stuff. Could be a pot stock, stock, crypto, whatever floats your boat. A small cap, artificial intelligence stock. There are so many ways to lose money in the market, and you might hit it big on something for a little while. And I hope you do, and I hope you get out. From my experience, most investors don't get out. They just hold forever, ride them up, ride them down, or they ride them up and then they plow their money into the other similar investment, which has also already gone up. You have to know what to hold to know what to fold, right? As was it Kenny Nelson saying that? So we need to do more of that. I find that when you try to hit the risk button too hard, to try to hit the return button really hard, you more often than not, it backfires. And even if you're right one time and you make lots of money, usually you do it a couple of times and you give it all back. It's like if you've ever gambled, how many times have you been up a lot? Wow, this is fun. And by the end of the night, you give it all back. Now I hear people, oh, I made money. I walked away. Yeah, after you made from here to here, you give a lot back. And maybe you have a little something left over. You say, well, screw it. I'll just go out and buy a piece of jewelry for my wife or pay for a nice dinner or something. And that's the end of it. So that's what happens when you're behind the eight ball. Okay. Now, I want you all to know how happy I am that you're joining me. If you have any questions, I love hearing from you. It's the best part about doing this. So let them rip. Hit me up with questions in the comments. That's what they're there for. Words of wisdom, words of encouragement are always appreciated. And while you're watching, if you don't mind, give us a thumbs up, a heart, an applause, a wow, whatever reaction is available depending on which social media platform you're watching. I see James out there. Hello, James. Lots of love to you, my friend, in Australia. Hey, we are about to switch seasons because you guys are just finishing up your summer. You're probably about to head into your autumn, into your fall, and we're about to head into our spring. So I can't wait to switch seasons with you. I cannot wait uh, for the warm weather. Although in my neck of the woods, it is really warm out. It's like I think it hit 70 degrees today on Long Island, and in the middle of February, that's like incredibly warm. I mean, this is all I'm wearing. I'm not even wearing a jacket today. I do have an umbrella in my office. It looks like it's going to rain. That often happens, right? When you get the warm weather and the cool weather, uh, you get rain. So anyway, um, we are 38 degrees Celsius today. 38 degrees. I am sorry to say, but I don't know what 38 degrees Celsius is. So I'm gonna have to look that up. No way. That's over 100 degrees Fahrenheit. Holy cow, that is a hot one by you. Mm. It is sweltering by you. Hope you guys get some cool weather soon. The United States, I think we were supposed to go to the metric system when I was a kid. I'm 55 now, and obviously it never happened. So we'll see. But I hope you guys get some cool weather, and more importantly, hope no fires, because I hate seeing pictures of the animals and the wildlife get destroyed there. Like, I think it was last summer, or the summer before, Australia had those crazy fires like the whole summer. It was heartbreaking. All right, let's talk about the market today. So the stock market finally buckles under the weight of inflation. The PPI, the producer price index, came out much hotter than expected, spooking the stock market, spooking the bond market, spooking everybody. Interest rates are flying higher. Mortgage rates went up again today, just ahead of the home selling season. First time unemployment claims out this morning below 200,000. So that means there are under 200,000 people filing for first time unemployment claims. That's a very low number. The expectations was it would be 200,000. Last week's low number was revised even lower. That just tells you that the labor market continues in the United States to be very strong. And that's why, a lot of people are still bullish. People constantly say, well, we're having inflation. The market has to go down. Look, the market could do anything over the short term. It could go up. It could go down. Whatever. I mean, we're not out of the woods yet. No kidding. When people say that stuff to me, I'm like, you're just Captain Obvious. No one here at Client First Strategy at my firm is predicting what the market's going to do tomorrow or next week. We're looking at way further than that, guys. All right. And if today's inflation numbers changes your whole investing outlook for your whole life, feel bad for you. You're not doing it right. You're just flipping your money back and forth. So anyway, I'm going to roll the introduction in a second. We're going to go through the markets today because we finally had, I've been talking to you about the market's been in a tight trading range all year. And today we finally had a real more solid down day. And the reasons for that are very simple. I'll give you those in a second, but I do have to get this disclaimer, my intro with the disclaimers going. So let me punch this out. Stick around, and we're going to be on for like another 5.5 minutes. Here we go. All right, thank you for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. Inflation numbers came out a little hotter than expected, sending stocks down, sending interest rates up, including mortgage rates, the 10 yield on the 10-year Treasury. So what's going on here, and what do we do about it? Okay, so a couple of things you need to know. It's been expected that the Fed would raise rates 2 more times in its current rate hiking cycle. The Fed raised rates 8 times so far, including 4 3/4 point hikes in a row. Now we're expected to go to 2 quarter points. The thinking now is the Fed might have to raise rates next by 0.5 point, and the time after that 0.5 point, and the rate hiking cycle looks to continue a little bit longer than we expected. So maybe we're going to get 4 more rate hikes. And the thought that the Fed could cut rates by the end of 2023 is basically going out the window as a possibility. Therefore, we have to wait longer for the hope for pivot, the Fed pivot. That's when the Fed starts cutting rates. We're going to wait longer for that. Therefore, there's less impetus or urgency to buy stocks. There's certainly more impetus to sell stocks if you're worried about rising rates. Rising rates makes future earnings of companies worth less in today's dollars. So when rates go up, companies' future earnings are worth less. Therefore, the stock could be worth less. This is especially acute in high-flying stocks or companies with very high P ratios or companies that have no earnings. P ratio is a price over earnings per share, and it's basically a very commonly used view of how to measure valuation of stocks. I don't think it should be uniformly applied. I don't think it should be uniformly applied to the entire stock market. I think it depends on the sectors and things like that. So, quick thing about P ratios: if a company is growing at, if a company's trading at 10 times earnings, so let's say the stock is $100 a share, they make $10 a share in earnings. Okay, 100 divided by 10 is 10. So that's a P ratio of 10. It's trading 10 times the value of its quarterly earnings. Now, what could make that P ratio go up or down? Well, if the company is growing at, let's say, 20% a year, the P ratio wouldn't be 10, even though in the last year they made $10 a share on the $100 stock. It would have to be worth maybe 20 times earnings to reflect 20% growth, maybe even more. And if the company was shrinking and next year they were expected to only earn $6 a share, the PE ratio would probably be more like 5 or 6 times earnings. And if it paid a decent dividend, maybe we'd be at 7 or 8 times earnings. And then there's the overall interest rate picture, which makes PE ratios go down. Okay, so there are a lot of ways to value stocks, but based on expected earnings growth, based on a dividend, based on interest rates and inflation, those are the things that really affect the price of a stock. And if you're optimistic about those, a stock could be worth more than a P ratio could suggest, or the P ratio could already be up, and it could be, the valuation could be reflected in the stock. Ultimately, stocks do find their true valuation, but while they're getting there, they trade all over the place, often with little rhyme or reason, which is why Mitch over here doesn't get nervous or excited when stocks have big moves. It's just another day, my brother. So that's what we need to focus on. Don't get all caught up in this stuff. So when the inflation numbers came out, the markets were down about 250, the futures in the Dow. And then, by the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Then futures, the market looked like it was going to trade up. I think the markets did trade up for a second today. If they did, they got very close. Believe it or not, I don't look at the market all day long. It doesn't make any sense for me to do it, and it doesn't help me or bring any value to me or you or anyone else to look at the market all day long. So let's just take a look at what happened today. Okay, the Dow down 430 points, down a little over 1.25%. Volatility doesn't really get me going, but moves in the major averages of 1% or more definitely get my attention. So the Dow down 1.25%, Nasdaq down almost 1.8%. That's a pretty substantial move down. I didn't say it's not common. It happens. The Nasdaq is known for 2% moves. That happens often, but it still gets your attention. And S&P down 1.38%, down 57 points. Gold is basically up 0.1%, basically flattish. 1 basis point up, big deal. Oil down a little bit. By the way, energy stocks have been getting pummeled lately, and oil has not gone down that much. But it's sentiment, okay? People are worried about the price of oil going down more than they are about the price going up. And VIX is up 1.94, slightly over 20. That's that number right there, 20, that I've been talking about for so long. That we get to over 20, that means the worry is starting to creep in. And I think we are definitely susceptible to a bigger sell-off, technically speaking, because when the VIX goes below 20, it's calm. There's maybe a little complacency in the market. But that doesn't make the market go down, or signal the market could go down. But when the VIX goes from under 20 to above 20, that's the kind of directional move at that point where the market could really get very rocky. Time will tell. We shall see. This is more helpful to me, maybe if I have cash on the sideline, cash on a client's account, and I want to put some cash to work. Okay, that as an example. Okay, but all you really have to know is the bonds. All right. The 2-year up 4.7, the 2-month, 4.7, the 4-month 4.9, the 6-month T-bill solidly in the 5s, the 2-year not far, the 1-year almost, it's 4.99%. I think we could just round that up to 5%. And the 10-year at 3.8%. we are very close to seeing the 10-year yield reach 4%. I'm actually surprised it's not there already. And mortgage rates are about 6.35, 6.4% nationally. It's an average. That doesn't mean that's what you're going to get in your mortgage. You might do better, you might do worse. It depends on the lender, it depends on your credit score, a whole bunch of things. But basically, with inflation becoming stickier, a little higher than expected, I could see yields going higher. So to me, if yields should have been higher, and I'm surprised long-term yields, interest rates are not higher, then that just means I expect them to get there soon. That's my own opinion. You do with that what you will. But I could tell you, if you want a place to put cash for 6 months, there's nothing wrong with a 6-month T-bill that pays 5%. Nothing wrong with that at all. Super safe, guaranteed to get your money back. It's a T-bill, short-term treasuries. Treasury securities, treasury bonds, when they have a year or under to maturity, we call them treasury bills, T-bills. So the T-bill 6-month is 5%. But this is really all you need to know with regard to what happened today. Interest rates up, stocks off a little bit. So your bond funds are starting to go down, or are going down. Your stock funds are going down. So diversification is not really helping right now. Diversification is a strategy that we use to diversify, to reduce risk, but it doesn't necessarily prevent your portfolio from going down in the generally down market. If you didn't know that, I have to tell you that. Okay. So that is basically it. Inflation is here, a little stronger than a good deal stronger than what we expected on both the consumer price level and the producer price level. It's going to be a couple of weeks until we get the next non-farm payroll figures, and until we get another month until we get the inflation figures. So I don't really see anything to change the direction of stocks, which right now is down for the next couple of weeks. So if you're looking to buy, maybe buy incrementally, buy a little now, use some stop loss orders to buy, or buy limit orders to buy a little bit lower. Have things preset and automated, because you know that if you don't do it, it's not going to happen. Keep the faith. I'm a long-term investor. I'm much more concerned with how stocks do between now and 2023 than between now and between now and 2033, if I messed that up, than how stocks do by the end of 2023. 2033 is what I'm looking at. And no, that's not the year I retire. I'm not retiring for a very long time. This is the kind of job where people just do it forever. We financial advisors, we're known to die at our desks. Plus, I love what I do. So that's it. I will not be doing the live tomorrow. I typically don't do it on Fridays unless it's a really crazy down day. My radio show is going great. If you wanted to know, I have a radio show every Monday through Friday. It's a live show, 9 a.m., about the stock market, personal finance, things like that. Very similar to what we cover here. And it's going well. I thought I would live stream it, but I have to tell you, it's a distraction when you're trying to do a radio show and stream it at the same time. So I will have all of the MP3s from the radio show on my YouTube channel very soon, with a countdown timer and everything. It's going to be really, really good. And I'm just about ready to do it. Hopefully I'll put them all tomorrow and on my YouTube channel. And that'll be like my podcast as well. So that's what's going on here. I hope you guys have a great rest of your evening. Thanks so much for joining me. If you have any questions, reach out to me. If you want to learn more about me and you want to take this conversation into a personal conversation, you can check me out at clientfirststrategy.com. And I'll speak to you soon. Have a great night.